Hey guys, it's Jeff with Simply Derivative. Hope you're having a fantastic Friday today. Wanted to take a few minutes and do a short video on a topic that we're getting a lot of comments on, a lot of questions, and really what you need to know about this particular topic that you've probably seen all over Bloomberg and CNBC and all over the financial media, and that's the yield curve. And the yield curve keeps getting brought up. You hear recession associated with it, and so I wanted to take a few minutes and really, tell you what it is, why does it matter, and really what to do about it. Those are the three things that we're going to talk about with this yield curve video. It's going to be short and sweet, right to the point, and hopefully you guys gain some insight into what it is and how to position yourself properly when the time is right. And so let's just get right into it. Number one, what is it? The yield curve. You hear it all over the place. You hear it, you read about it, you see a recession associated with it. And in the most basic terms, what the yield curve is taking two government bonds and you're getting the spread between the two. That spread is either moving up or moving down. It's upward sloping or it's negative sloping, and it's on its way to invert. And that's why it's getting brought up these days, is because of the angle and the direction at which this spread between those two instruments is going. And it's going down, and it looks like it's heading to go below zero, which means it would invert. Why does it matter? Well, there's a couple of reasons why paying attention to the yield curve matters. Number one, the Fed, economists around the world, around the globe, around the US, institutions, banks, hedge funds, they use this type of information, specifically this spread between the two instruments, to kind of gauge the overall health of the economy, where we're at in a credit cycle, where we're at in a business cycle or economic cycle, and can kind of position themselves going forward. And if it looks like we're headed to recession, well, that's going to mean some things for your money, and it's going to mean some things for the stock market. And so that's why it matters, because it can have implications going forward for your money and for really your day-to-day life. And so it's something that traders, like I said, institutions, economists, and banks, even the Fed, of course the Fed pays attention to this. It gives us a really good idea of where we're at as a whole and where we might be going. And so, lastly, what to do about it? Well, there's a couple things that you can do. Right now, we're kind of in this waiting period. Earnings are good, the economy's growing, everything is strong. We're going on the 10th year of this bull market, but all good things must come to an end at some point. And it's just the nature of cycles, whether it's the stock market cycle, the business cycle, the economic cycle. There are times when you need to position your portfolio and your investments and change your perspective based on market environments. And so, there are some ways to reduce risk, raise cash, take advantage of the downside move that could potentially come with this, because if we have a recession, that's going to mean certain things for the markets. And so you're going to want to position yourselves correctly. And so what to do right now with the yield curve? There's not much to do except pay attention to it, see where it's going, and gauge your risks and exposures as we get closer to that zero line in the inversion. We're not there yet. We're going to look at some charts right now and kind of get an idea of when we could expect this to happen and really what's going to happen after that. And so let's take a look at the screen here. We have our Thinkorswim platform up, and like I said, we have this spread up, which is the difference between the 10-year bond, 10-year note, and the 2-year note, and that gives us a spread between the two. And that spread, based on this chart, right now is at 0.28. So 28 basis points is the difference between the yield on a 10-year and a 2-year. If you look back at this red line, this goes all the way back to July, funny enough, the same week in July of 2005. And at that point in time, we were right around where we're at now, 24 to 28 basis points between this spread, or with this spread between these two products. The yellow line, this yellow vertical line, is showing when this spread went negative, and that was in December of 2005, right before 2006. With the Fed raising interest rates at least one more time, possibly two more times this year, we're potentially going to see similar action in this spread narrowing further and getting closer to the zero line before it inverts. And so we're thinking closer to October, November, December is when you're going to see the spread start to invert. And at that point, really the race is on before the markets peak out and before the economy really peaks out. They say it's going to be different this time. It's not. It never is. It doesn't matter which way you get here, whether the long-term rates are coming down or short-term rates are going up. The yield curve is flattening, and it looks like it's headed for an inversion, which can signal a recession. And so that's why all of this matters. And so we kind of use this chart to time when that's going to happen, and when it does, then we can take some precautions with our portfolio, with our money, and do certain things that we need to protect ourselves from a potential move. So if you look to the left over here, we have SPX, which is the S&P 500. We have a 20-year chart with a weekly, and we're looking at those same red and yellow lines back in time, and you can see that initially the market had a pullback when the yield curve was, as it was coming down. We had a nice little pullback, rallied up, took out new highs, made new highs, and then further made new highs. It took about 5 months for the market to peak out after the curve inverted. And this is something that has happened over the past 7, 8, 9, 10 recessions, is a yield curve inversion, which leads to the recession and the markets coming down. And so there is some time before that, before the market can experience, some extreme downside. So with that being said, if we're expecting the yield curve to invert close to the end of the year in December, kind of exactly what happened back in 2005, 2006, it was about 14 to 18 months before, you had Lehman Brothers collapse, Bear Stearns collapse, before the great financial crisis. And so what can we expect with our markets? We had already put in a high, and back in January 26 of this year, and we're getting pretty close to it. NASDAQ is broken out, Russell's broken out, but not the Dow and the S&P. And is that a sign of things to come, or are we going to move up higher in that time frame while the spread continues to narrow? And it's only a matter of time before we see a bear market upon us in the markets, a true bear market. We don't know if we've already put in a top in the S&P, but we are struggling where we're at now, around this 2800 level, 2820. And so we may expect to see a pullback a little bit and then rally into the year end and the start of 2019, and then all bets are off at that point. If the yield curve is inverted at that point, like I said, it's a race against time at that point. You're going to want to position yourself properly. You're going to want to protect your portfolio. If you're long, you're going to want to raise cash if you can. The time frame at which it goes inverted to when the market peaks out and when the economy peaks out, that's subject to each cycle, but on average, it can range from 4 to 5 months for the stock market to peak out, and then another 8 to 12 to 14 months for the economy to peak out. But the stock market and the markets are forward-looking. They discount things in the future, and so you may have this further run-up and real strong move to the upside before all of this comes into play. So that's about it. I hope that answered some questions. I know we've had a lot of comments around the yield curve, what it is, and how do you look at it, and what's the purpose of it. And it's really basic. It's an indicator that you can look at to kind of see where the economy as a whole is at its current condition, and then you compare that to where the markets are at, and you can potentially protect yourselves and your portfolio and your money, and really take advantage of that big down move whenever it does come. Not saying it is, but the curve is headed down, and that has tended to lead to recessions in the past. history repeats itself. The markets are really comprised of two emotions, greed and fear. Those aren't going to change because it's human behavior. It's humans that are in the markets. It's humans that are programming the computers that are trading the markets. So it's all coming down to human emotion, human psychology, and that's not going to change as long as the markets are around. So, with that being said, guys, it's a complex subject, but we try to break it down as best as possible. But if you would like to know some more about this topic and how to really take advantage of it and the markets in general, feel free to check us out at simplyderivative.com. Be sure to subscribe to our YouTube channel and follow us on social media. We'll see you next time. Have a good day.